Let's now go to Kenya and get our update from Steve Ogada, fixed income trader, Sterling Capital. Steve, good morning to you. There's a lot to talk about the budget yesterday, a bigger budget than last year, but also the finance minister aiming for and saying the economic growth rate of 5.2% is maintained, even hinted at 6% in the medium term.
Yeah, I think it was a good budget, mainly covering areas of economic growth, looking at factors that are affecting that sector. They address the issues of infrastructure, the issues of security, issues of investment in human capital. And the big boys in the budget included infrastructure with double-digit allocation of about 24%, education just coming in after that. And I'm thinking the growth target is quite achievable because they're looking at inflation targeting of about 9%, which should slide lower to 5-7%.
This turned up almost, and surprisingly, the inflation target of 9%, because initially the central bank has always said the inflation target is about 5%. But all of a sudden that has been lowered. Does this sort of give an indication of what to expect in future?
Well, I think while initially the figure was 5%, you see, we're coming from a double-digit inflation regime, and it has been declining successively over the last couple of months. And with the current high interest rate environment being maintained by the central bank, we should be able to achieve single-digit levels.
The budget deficit at 6.5% of GDP to 50.3 billion shillings. He's going to raise a lot of this through 106.7 billion at least through borrowing from the local market, but also bilateral and multilateral creditors. What is the likelihood of success for these?
Well, 106.7 is quite, it's a walk in the park for for domestic borrowing in the country, because in the past we've seen higher figures, and we've been able to, the government has been able to raise that. So I think going forward, well, people expected the deficit will be quite huge considering the increase in spending. But I think 107B is quite a modest figure, and I don't think it should really have an impact on rates edging upwards going forward.
He even hinted at a Eurobond in the next fiscal year, depending, of course, on what the global economic conditions are like. Yes,
I think the government is really working towards ensuring that there's economic stability in the country, hence the allocations to infrastructure, security, judicial reforms, and all this works towards improving the country risk. And now with that, with an improved country risk, then the risk premium, of course, declines. Now with that, then you're able to price your debt much more cheaper, and be able to attract financing even for a Eurobond, as you mentioned.
All right, the IMF issuing an interesting statement saying that the country's net public debt might dip below 40% of the, by the end of 2014-2015, 40% to GDP, and they say this is because the efforts on fiscal consolidation are working quite well. Do you agree?
I do agree. I think our ratios are still quite attractive. I mean, look, even the 6.5% percentage of GDP as budget deficit is still within the 5% normal accepted region, even for the developed economies. And we've always maintained just slightly above 50% of debt to GDP. As per the finance minister's projection, that should decline towards 40%. And we are already seeing how, what kind of reforms, especially like tax reforms that are being undertaken to ensure that the government is generating more income and be able to offset the current debt numbers that they have.
The 91-day T-bill was a bit shunned yesterday, and you're telling me this has something to do with the yield?
Yes, I think when central bank introduced the term auction deposit yielding 18%, really it's a no-brainer. Why would investors, especially banks, pursue T-bills at 10%? So really looking at opportunity cost comparative return analysis, the banks have been looking at putting monies at participating in the TAD, and this is risk-free. 18%, this is is very attractive for them. The only issue is that then there's an element of crowding out, because then funds that would have otherwise been distributed to the private sector are being held by a central bank. But I think going forward we should see this being relaxed and rates starting to decline.
Basically, the thinking, Steve, appears to be that if you can park money with the central bank for just 28 days and earn 18%, then there is no need for you to go treasury for 3 months at 9%.
Exactly.
Excellent. On the fixed income market at the Nairobi Securities Exchange, there appears to be a bit of a lull right now, not too much activity. How so?
Well, we're closing second quarter. So the major participants are comfortable with their portfolios at the moment. They've really benefited from the rally that there was in the past couple of months. So we are seeing very minimal participation from investors. And what we've seen, like as at yesterday, were just sell buyback positions, which were basically securities going back to the borrowers. In terms of straight trades, they've been a bit subdued. It's the IFB5 that has been quite liquid and trading mostly on the back of improved yields.